In order to consider the viewing of this video as structured CPD, you must complete the reflective statement to demonstrate what you've learned and its relevance to you. In this academia program, we're looking at investment trusts and their role as a provider of equity income to investors. I'm Mark Colgate, and I caught up with 3 managers to discover their views on today's markets, how they're investing, and how the investment trust structure affects what they do. The 3 are Sue Noffke, based in London and manager of the Schroder Income Growth Fund plc, Kathleen Anderson, manager of the BlackRock North American Income Trust, based in Princeton, and Paul Atkinson, head of North American Equities at Aberdeen, and he runs the North American Income Trust from Philadelphia. So what is the outlook for equities as an income asset class? Here's Sue Noffke of Schroders.
UK equities stack up very well as an income asset for 2014 and beyond. The historic yield on UK equities is 3.3 currently, 3.6 prospectively, and that compares to the yield on UK 10-year gilts of 2.8. So you've got potential growth from UK equities. In terms of dividend growth, probably about 7% or so for the next couple of years. I think that's a very compelling case for people holding UK equities as an income play.
And what about North America?
I think they're very attractive for 2014 and beyond, particularly as we look at an environment where interest rates are starting to creep up again. It's going to make, I think, bonds a little bit less attractive as an investment. Actually, people are saying people should really rethink their bond portfolios and be a little bit more flexible. And I think people will be focused more on the fact that in equities you have a growing stream of dividends, so your income is going to keep rising, whereas in a bond market you don't have that growing stream of income.
As you know, the S&P was up 32% or so last year. Certainly, I very much doubt whether you'll see that. Much more modest returns is what it feels like this year. In terms of the trust's equity holdings, I think operating profit growth in the region of 5%, 2.5% for GDP growth, a little bit of margin expansion. Then you've got the dividend and you've got the potential, which is say 3%, and you've certainly got the potential for say a 1% net buyback. So that gets you to high single digit, low double digit. That's before you talk about any expansion to valuations. We're certainly not reliant on that, but operating profit growth looks good. We're confident, 5% plus.
We're seeing the recovery in the US economy overall, but it's not the strongest. What's taking place at the corporate level?
You're right, the US macro is been a bit up and down. I think what's been obscured is the real recovery in corporate profitability in the US. I mean, corporate profitability from March 09 through to just about now, it has doubled, and it's good quality profit growth. It's real cash being generated, and it's being generated, and I would argue in a very sustainable way. US corporate profitability now is on record highs, and I think that's sustainable. We don't see wage growth growing faster than productivity. Productivity is still above wage growth. That's good for corporate margins. Commodity prices, natural gas, it's still cheap. There is no commodity price pressure impacting margins, and commodity inputs are still an important part of the cost of the finished good process. Don't see pressure there. And of course, we don't see pressure on interest rates expense either.
But with so much QE around, is that a disadvantage? Does it distort equities as income payers?
Well, what QE has really done is made it more difficult for investors to find what we call like a safer yield. QE has reduced, treasury rates, but it's made yields on equities much more attractive. So from that perspective, we find that QE has helped. Where QE has also had an impact is on the companies that we look at. QE has helped a lot of low-quality companies survive the past couple of years because it's provided cheap, easy capital for them. So that's something that we watch very carefully.
It's definitely distorted the income characteristics of bonds. QE has certainly boosted the demand for risk assets, of which equities definitely have benefited. But I don't think it's necessarily distorted the yield on UK equities. If you take the yield historically of 3.3% on UK equities. That fits very neatly between the long-term trend of 3 to 4% for UK equities. So we sit kind of mid-range for the yield on equities as an asset class.
Equities have had a strong run in developed markets. Are managers worried that share prices are not going to be justified by future earnings?
The UK equity market has re-rated over the last couple of years, really as the risks around Eurozone breakup have receded, but earnings haven't come through yet. We're starting to see good forward leading indicators such as the Purchasing Managers Index, which are very well correlated historically with earnings. So I'm confident that we will see earnings increases come through over the next year or two. We do actually need those for the market to go on to achieve further gains. And we're seeing more confidence from company managements about levels of investment in CapEx, in M&A, and I think that bodes well for profitability going forward too.
Is now the time to focus on companies getting their earnings from domestic or overseas growth?
Certainly on valuations have certainly corrected. Last year was certainly a period of derating for the overseas earnings. The domestic earners got a little bit were cheaper at the start of the year, and as a result, one of the shifts that we did as the manager of the North American Income Trust was to take back some of the more expensive overseas earners and then look at the more domestic earners. Those domestic earners have been they're a little bit more cyclically oriented, which does introduce a new element of risk. So we were very conscious of not wanting to make a big macro bet. It was very much, are those companies, have they got a history of sustainable yields which are being financed by good operating cash flows? And therefore we were able to pick up some more domestically focused companies like a Nucor, like a Wisconsin Energy, even like a Wells Fargo. Those companies we certainly gave a little bit of additional diversification to the equity holdings, and we were able to take advantage of some cheaper domestic. This year it looks like the overseas has got cheaper again and it's much better value. We're comfortable with that.
My portfolio has a good exposure to a wide range of UK equity exposed stocks that have a lot of their earnings coming from the domestic market. Where I'd like to see more opportunities emerge is from the more international stocks that have probably been held back by a combination of fears around slowing emerging markets growth, worries about Europe, is it on a sustainable recovery path, and also the strength of sterling, where overseas earnings are being held back from currency translation.
Well, I mean, we are seeing a pickup in Europe, a little bit of a pickup in Europe. Right now, the emerging market weakness is hurting some of the global names that we do invest in. The majority of our portfolio is U.S. biased, for sure. But, you know, Europe is not going to stay down for very long. It's going to turn around. And as I said, we're starting to see a little bit of signs of improvement there. So, you know, we're mainly domestic biased, but we're not totally, you can't totally ignore the whole world. The stocks that we tend to look at and invest in are global in nature. So we look for the best market.
If you think globally as a manager, then how does currency affect the way that you invest?
Well, we tend to be very long-term holders of the stocks that we buy in the portfolio. We try to invest along the same length of time that the managements are investing within their own companies. So when you look at currency, it's very expensive to hedge away your currency risk. So that's something we haven't done. We do pay attention to currency, but it's not an overriding decision as to whether we hold a stock or not. Over time, currency tends to wash itself out in terms of being a positive or a negative for you.
And what about Schroders? Is currency a reason enough not to invest in a stock?
No, but I'm looking at switching some of my holdings, taking profits from the likes of ITV, which has been a tremendous stock for the portfolio. It's been leveraged to a more buoyant advertising environment, as well as a lot of self-help from new management initiatives. And is probably looking at recycling some of those gains into stocks that are well placed internationally for the next 2 to 3 years. So the likes of Inchcape, which is an international car retailer and wholesaler, has a lot of opportunity to expand in some of its emerging markets, although it's also done very well in the UK. So it's that balance shift, still riding the good UK economic tide, but looking for opportunities to move the balance of the portfolio probably a little bit more international over the balance of this year.
You mentioned Inchcape. What's it doing to create a strong and sustainable dividend?
The interesting characteristic of Inchcape is that it's very cash generative and it has a capital light business model, so it can self-finance its growth and pay attractive dividends back to shareholders. It's also using its balance sheet, which is quite efficient, to increase share buybacks to investors. So if you look at the total return as an investor in terms of what you're getting back from the company, it stacks up very attractively.
And what about a stock that fits the bill in North America?
Comcast is the largest cable provider in the U.S. They have a pending merger with another large cable company called Time Warner Cable. Over a year ago, they bought in the rest of NBC Universal from GE. They got it at a very attractive price. Comcast is, big in the local cable TV business, but it also has a programming arm. It has now theme parks. It has a broadcasting station. So whenever people talk about cable TV companies and the pressure that they're under, well, Comcast gets both sides of it because, yeah, programming costs are going up, but by the way, they also provide programming. So they've really turned the company around in the last few years in terms of becoming more shareholder friendly, and that's basically why we purchased the shares when they became much more shareholder friendly. Historically, cable companies kept investing in their networks, which they needed to do, but it was a little bit of overinvestment as far as we could see at times. And now it's much more focused on returning cash to shareholders. And so we've seen some very good dividend growth from Comcast, and that's why we like the stock.
And for Paul Atkinson, what about Wisconsin Energy?
It's in a great geography. There's some good industrial growth there, so the underlying demand for its energy is growing quite nicely, or 3% or 4% or so. It's got a very tenured management team, and it's got the ability to grow its dividend in line with its earnings base. For a utility, it's unusual to see a utility growing its earnings 5 to 7%. Wisconsin can do that. That earnings growth of 5 to 7% will get passed on through the dividend. So we think that's a very good stock. That's an about average level of dividend growth for the portfolio. Slightly, maybe just a little bit lighter, but the valuation was corrected on Wisconsin, and there's very little capex risk around Wisconsin. So a good utility. It got cheaper, and it's got a dividend payout ratio that can go higher, and it will be a good grower in the context of utilities.
With so many investors becoming ever more reliant on income, what are equity managers doing to secure diverse and sustainable sources of income for them?
It's a fascinating market within the UK because the UK equity market is quite concentrated. It's even more so by income. So the top 10 stocks in the UK equity market account for some 40% by market value. More than 52% of the income generated comes from those 10 largest stocks. So it's important as an income manager to create a portfolio that both takes advantage of that but differentiates from the market so that you're adding something different and being able to outperform that benchmark index. And the way in which I do that is to look for interesting situations outside of those 10 largest stocks, to look for stocks outside of the UK equity market as well. So currently the portfolio I run has about 10% that's non-benchmark, non-FTSE all share. Some of that is overseas, and some of that is from off-benchmark holdings that are essentially UK equity companies.
When you look at those 10 largest income-producing stocks, what's your exposure to them? What do you cap it out at?
Well, I try and cap individual holdings at 5%. 5% by market value and about 5% by income. Because what I feel that my investors in the fund really want is security of income and income growth. And what I can do to ensure that that happens is to run quite a diversified portfolio, but it has to be focused enough to deliver both capital returns and that income and income growth generation to make it attractive.
The BlackRock North American Income Trust is benchmarked against the Russell 1000 Value Index. How good a pool of equity income stocks is that?
Well, to be perfectly honest, there really is no good benchmark out there for a broad index that just captures income producing stocks. With respect to the Russell, we use it, about 70% of the stocks within that Russell index do pay a dividend versus say 80% in the S&P 500. It was the best proxy that we could find. You know, we did an extensive search. It was the best proxy we could find in terms of a benchmark that was broad-based for us to use to measure the performance. The secondary benchmark in a lot of our funds is the S&P 500.
The North American Income Trust uses the S&P 500. Are there enough income stocks there?
There are certainly enough for our purposes. I mean, we only invest in 42, 43 companies. We can really focus on those of the highest quality and the best valuation. As a result, the equity portfolio yields 3.5%, which is exactly what the trust yields. It's dividend income that's doing all of the heavy lifting in terms of what the trust distributes, and there is certainly no shortage of companies that we think are great for the long run, good quality yields with the ability to grow. It's very important that yields do grow, that they grow in line with earnings and operating cash flow or free cash flow, just the type of companies we want to look at.
The UK is a relatively small market compared to the US, but even the US fund managers are looking outside their home markets.
Yes, we can invest outside the USA. But what we tend to do is we look for companies that are the best company within their industry. We're not going out and buying, say, an Italian retailer. That's not our strategy. That's not what we do. That's not what we do well. But if you look in, say, the metals and mining area, the best company may be based in Australia as opposed to the US. So we'll buy that particular company in Australia. We also buy a lot of global names as well. So, you know, who's really to say? I mean, Coca-Cola is based in Atlanta, Georgia, but the majority of its profits comes outside of the U.S.
Canada has some very good companies. 10-12% of the equity portfolio is invested in Canadian companies. We've got the likes of Royal Bank of Canada, we've got Potash, we own TransCanada, we own TELUS. These are very high quality Canadian companies that have that ability to generate cash flow and a willingness to give it back to shareholders. In North America, we want to go where the quality is, where the value is. We think that's the right way to address this asset class.
And is there much that fund managers can do to encourage companies to pay out dividends? What sort of incentives do they think are appropriate for company management?
I think it's very interesting as to what are the right levers for management incentives to be. As an investor, I think it's important that management have an element of total shareholder return. The other aspects that form part of their incentives can be around cash generation, balance sheet efficiency. We don't like to see too much of earnings growth per se, because you can manipulate those earnings growth. But it really depends on the nature of the company involved and what stage it's at. Clearly, for a growth company, you do want to see them investing back in their business. For a mature company, it may be appropriate, such as AstraZeneca has had, a dividend aspect to the management incentives. And that gives comfort when the likes of AstraZeneca is going through a change program under new management, and it's going from a cost-cutting phase into an investment phase in its research and development.
The UK prides itself on having a dividend-paying culture, but there are an increasing number of equity income portfolios tapping into overseas markets such as the US. Does North America have an established dividend culture?
It's certainly becoming one. It's in the very early innings of a shift to greater distributions. You'll know that that dividend payout ratios are historically low at the moment, 30-odd%. You'll know that from 2000 to 2010, the investors and the market was very much focused on capital appreciation. I think that's moved on now, and clearly CEOs are being compensated to do the things that are in the interests of long-term shareholders. That's organic growth. That's to grow operating profit. Things that are good and are done before buybacks. So I think the magnitude of what's distributed is increasing, and also the mix of distributions are increasing too. That's a mix away from buybacks and towards dividends. Early stages, it's got more to run. CEOs are very focused on it, and companies appreciate that they do get re-rated for having an interesting yield that can grow through time. And buybacks are, the market sees through buybacks now. If they're just manipulating EPS for a compensation process, that's certainly not really in the interests of shareholders. And I think CEOs understand that now.
That's all well and good, but historically, what sort of element of total return has been provided by the dividend?
Well, over time, if you look at what the S&P return has been, 40% of that has come from the dividend or the income portion of the total return of the S&P 500. So, yield and dividends are extremely important to the total return. So, and also you have to keep in mind, dividend paying stocks tend to be less volatile than non-dividend paying stocks. So that's also, very good for a total return portfolio.
Equities as a total return strategy, it's very compelling. And the income component is very key for long-term investors. So if you take the last 50 years, for example, the total return in nominal terms from UK equities has been 11%. More than 1/3 of that, so 4% of the 11%, is actually derived from your yield. And then the rest of the component is actually derived from growth. Now, growth in earnings tends to lead to growth in dividends. So you could say that actually your yield and dividend growth components are what really drive the total return for an investor over the long term. Clearly in the short term and on an individual year-by-year basis, it's capital returns that make or break a particular year, and the yield component tends to be quite small. But over the long term, it's not a re-rating or de-rating of the market that drives total returns.
And is there anything else that fund managers can do, apart from tapping into dividends, to generate income for their investors?
I do look at boosting income from the trust through other methods than just income alone. It's quite difficult in a low yield environment to do that through cash or fixed income. It has been possible on a tactical basis to do that through overwriting stocks that are held in the portfolio, so writing covered calls in effect. But even that has been quite a struggle in a rising equity market, and a market for which the premiums available for writing covered calls have been much skinnier in a low volatile environment compared to the situation of 3, 4, 5 years ago. So we've done it modestly and tactically. It's probably added about 3% or so to annualised income since we've been doing this in 2012, 2013, but it has been modest.
It's a strategy employed by Kathleen Anderson as well, but are there any downsides to it?
The downside, if you want to call it a downside, is, say for example, last year when the market was up over 30%, you're not going to capture 30% gain in the market with a covered call strategy. It takes a little bit off the top, but then again, when the market goes down, that covered call strategy helps you in terms of giving you helps on the downside protection.
The North American Income Trust doesn't just invest in equities, it also has bonds in its portfolio.
Let's be clear on the yield of the trust. It's 3.5%. The equity portfolio yields 3.5%. The 42-43 holdings yielding 3.5%. There is a small element of bonds. Bonds are less than 10% of the equity portfolio, and they yield the corporate bonds investment grade and non-investment grade. 16 holdings yield about 5.7% on a yield to maturity. We're very comfortable with the quality of those holdings. The bonds contribute something like less than 15% of the total income required. The option overwriting program as well, it's not a systematic option overwrite program. It's very opportunistic. It really complements what we see at the bottom-up level around the quality of the company and valuation. And we are typical underwriters of companies. We have 3 or 4 option positions. Typically, we may have three put positions that are focused on companies that we want to increase exposure to, and we may have a call option just if we want to trim a position. Bottom line is there is no systematic option writing program on the trust. We don't really like the quality of the option writing program. We think that's a lower quality form of income. Too much reinvestment risk, too many moving parts. You don't know whether the portfolio is going to get called away from you. We like the upside. We don't want to find that called away from us, from our having 30% of our holdings called away from us. We're much more prefer a small amount of put writing on stocks that we want to increase exposure to. Combined, the bonds and the option overwriting program add about 25 to 30% of total income.
So what does constitute an attractive and a sustainable yield for an equity income investment trust in today's markets?
Well, I mean, we're targeting for this fund a yield of 4%. And I think that's very attractive, particularly when you look at the yields that you're getting within the market. And it's a less risky asset in terms of, some of these higher yielding bonds that you might want to compare it to. But I think a 4% yield is pretty attractive.
And can you manage that but also produce dividend growth over time?
Yeah, I mean, we look for companies that are growing their dividends. Towards the end of last year, we saw an big old industrial company called 3M, raise their dividend north of 35%. That came out of the blue, but we find these good, high quality companies that are raising their dividends pretty significantly.
So how does the structure of an investment trust help those in need of reliable income? Here's Sue Noffke.
For the trust, an attractive and sustainable yield for the portfolio is something that really depends on the structure of the portfolio. And as an investment trust, there's the ability to not distribute the whole of the income that's earned in good times. So you could find higher yielding stocks more attractive from capital return point of view, and the board collectively can take a decision that it's not appropriate to pay all that out in the current times. It's also possible as a fund manager to look to have a portfolio that is yielding a bit less and utilise the revenue reserves to maintain the payout distribution to investors. So I see it as quite a flexible position as a fund manager of an investment trust to set the dividend yield.
What level of revenue reserves have you got on the fund, and what's that telling us about your views at the moment?
The revenue reserves of the trust are just short of 1 year's income. That really reflects the historic strength of the trust in terms of its revenue generation, and it provides investors with a lot of comfort as to the sustainability of the distributions that are coming from that trust going forward.
But one of the key attributes of an equity income trust is not just a focus on headline yield, it's the importance of growing the dividend over time. Here's Paul Atkinson.
Dividend growth is very important for the trust. We're currently at approximately 3.5% yield. We've just announced a final dividend of 10p, which is 27 for the full year. It's a nice pickup, a nice 40% pickup from last year. Going forward, it's very much the desire of the manager to put Nate's board in a position where it can grow its dividend through time. I think the dividend policy is probably best summarised in 3 ways. Going forward, we want to give the board the option to grow the dividend mid-single digit, low double-digit types of levels, 5 to 12%, shall we say. We want that growth to be supported by the dividend growth in the equity holdings that we have. We also want to make a contribution to reserves. The 27p dividend was 1.1 times covered this year. I think it's important that the trust has a capital discipline and puts away, makes additions to reserves. We've got about 1.5 times of 1.5 reserves of equivalent to 1.5 times the 6p dividend that we see as the current core. We would like that to continue, possibly for at least for 12p of reserves or more, certainly more than that. And then we also want to see that 3.5% yield is competitive in an absolute sense, but also in a relative sense to peers, and also interesting vis-a-vis the, let's just say, the S&P index. I mean, large cap stocks in the US, they yield around 2%, 2.2% on a forward basis. I think in our minds we're thinking of about a yield of, on the equity portfolio, of about 1.5 times that, which gets you to broadly 3.5%.
One of the other key powers of an investment trust is it has the ability to gear. So in today's markets, what sort of gearing level do trusts have? Here's Kathleen Anderson. Her trust has a gearing level of around 2.3% at the moment, and it launched back in October 2012.
It was just a question, I think, of the timing when the fund started and where the market was at the time that the fund started. So the gearing is fairly low, yes.
And over time, are there plans to increase that? What do you see the gearing level being in the longer term?
I think it's sort of captured at, say, 10%. I think we can go as high as 20%, but that'll be a decision made by the options team that we have up in our Boston office that are expertise in that aspect. And also it'll be up to the board of directors too, because they have a say in that.
And what are Schroder's? How does Sue Noffke use gearing?
Use gearing modestly. So I took over the trust in late 2010 and felt that there was an opportunity to introduce gearing that hadn't historically been used, although it was approved for the trust. So currently gearing stands at 6% for the trust, and it's a dynamic conversation, fund manager and the board, about what role gearing can play in an investment trust portfolio. My personal view is that there is an opportunity to have structural gearing and tactical gearing, and that's something that we have a live debate ongoing.
Who's winning that debate at the moment?
I would like to say that I am. I think we have a good relationship with the board. We've demonstrated the use of gearing. Clearly gearing is additive in strong markets. It detracts from total returns in difficult markets. As I've said, I'm positive on likely future capital gains from the UK equity market over the next couple of years. The level and cost of financing is very attractive currently, and I think that there are opportunities that should be grasped to deploy gearing within the trust on both a structural and tactical basis.
The North American Income Trust has got a gearing level of 2.6%. Why so low?
We have a bank credit line of £30 million taken in dollars. It's very low financing. We've taken down half of it. Half of the gearing that we've taken down goes to put underwriting. So we certainly don't, so that explains some of the cash that may not show as actual gearing, but it is equity exposed cash, because we have to ring fence cash in order to make good the put liability, to match the put liability. In other words, the trust has to be good for the value of the stock that we may get given. I think the message is we don't need to use leverage in order to make the 3.5% on the yield. We were a little bit concerned about valuations last year at times, so we didn't feel we needed it. Certainly in periods of market weakness, we feel the fundamentals are still good, and over the next 12 months or so, we'll certainly look for opportunities to employ that additional gearing onto investors back into the trust.
By being closed-ended, there's a finite number of shares in the trust. Is that a help or a hindrance in running a portfolio?
You know exactly how much capital you're dealing with and how to generate the level of income that's required, rather than be subject to the vagaries of flows. So if there was a shock and the market took fright, or investors in your fund took fright, in an open-ended fund that could leave you short of income at just the wrong moment, because clearly there are seasonal aspects to the collection of dividends. You actually have to earn them and be around to collect them. So it gives me as fund manager a lot of visibility and certainty over running the portfolio and collecting the income.
I think it's fairly indifferent, just to be open about it. We also have a very large open-ended fund here in the U.S., and there's almost very similar portfolios with maybe no option overrights in that portfolio. We buy the same high-quality stocks in both closed-end and open-end funds. It's not like we're looking for illiquid names that we feel we can put in a closed-end fund. So, as you know, the only big difference between open-end and closed-end is closed-end, the money is in the portfolio and there's no, the flows are static, which is different from the open-ended fund. But we don't really see any difference in terms of our strategy or the type of names that we put in the portfolio.
It certainly doesn't hinder us. We are advantaged by there's not daily cash flow coming in or going out of the fund, because open-ended funds, if you're given money daily or money is taken away from you daily, then I guess there are the moving parts that the option overlay can create. So no, we don't necessarily, a closed-end structure is good. We've got the flexibility of gearing as well, and any discounts does create the opportunity for investors to buy the net assets of the fund much more cheaply. So it is a nice structure, and it certainly is it's certainly helpful towards the underlying portfolio.
The big flows of money tend to go into open-ended funds. A lot of investment trusts are on the small side when compared to their equity income cousins in the OIC space. But what are the pros and cons of running a smaller portfolio?
I think it's an interesting size. It's probably on the small size at £180 million within the context of the AIC UK equity income sector. It's smaller, it can be more nimble from a fund management point of view. I do not struggle to buy and sell stocks that I want to have. The drawback of that size could be around the wealth investors and the platforms, who probably see 100 million, 150 million as being the low end of what they would typically have as a recommended fund. So it's something that we're aware of. We like the size, it's not an impediment, but we just need to monitor from a marketing perspective the size of that fund.
The BlackRock Trust is even smaller, around £110 million, while Aberdeen's North American Income Trust is £280 million.
It can make you more nimble in terms of if you want to get in and out of a name, but I have to point out the type of companies that we invest in tend to be very large market cap companies. So we're rather indifferent, to the size in terms of how we pick names for the portfolio.
It certainly makes us nimble. We have got relatively small holdings in the context of in the marketplace, so liquidity is certainly not an issue. We like the size. We'd love to put a zero on it. It wouldn't impact. It wouldn't change the way we run the portfolio. In terms of the market cap spread, the average market cap is 50 billion. The smallest market cap is about 2 billion. Healthcare Realty is one of the smaller companies that we own. But liquidity is good, and we're not constrained in any way. And actually, it's not really a factor either way.
In order to consider the viewing of this video as structured CPD, you must complete the reflective statement to demonstrate what you've learned and its relevance to you. Among the topics covered by this Investment Trust Masterclass are the outlook for developed market equity earnings in 2014, how equity income investing works as a total return strategy, and using derivatives to boost a portfolio's income. Please now complete the reflective statement to validate your CPD.